Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 1. This is section B3. This is an application topic. Use assumptions such as the highest and best use, market participation assumptions, and unit of account, and approaches such as cost, income, and market approaches to measure fair value. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you're done watching that webinar, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to a lot of great stuff, including the Pro course, where Nate explains in detail exactly everything you're supposed to be doing every day to pass the exams. It's basically a much more in-depth version of the 1-hour webinar. And they also get access to the full versions of these YouTube videos. Now, usually there is a YouTube version of these videos and a member version, and the YouTube version is usually 5 questions or so, and the member version is usually 10 questions or so. Now, in today's video, to be honest, we are only going to do 7 questions for YouTube, and we're going to do those same 7 questions for members because this is a topic that's fairly straightforward and just a few different things mixed together, and it's pretty conceptual, so I didn't think that it was necessary to do a whole bunch of extra questions. I felt that the 7 that we have that we're going to go over today is enough for the YouTube version and for the member version. But again, remember, Superfast CPA Pro members usually get access to the full versions of these videos, which again are usually 10 questions compared to 5 questions on YouTube. So if you like this and you like our other videos, make sure you check out becoming a Superfast CPA Pro member because you will get access to the full versions of the videos when we post them in the member forum. So with all that said, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out in these videos is a strategy you want to do on test day, and that is you want to read the last question or the last sentence of the question first. And that's important because that will give you context most of the time for what the question is even talking about so that you know immediately what you're supposed to be looking for throughout the question. So you read the last sentence to get that context. So let's go through that here. Under GAAP, how should Blackthorne determine the fair value of the machinery? Let's go to the top. Blackthorne Inc. is estimating the fair value of a piece of machinery it owns. The machinery has unique modifications specific to Blackthorne's manufacturing process, making it more valuable to them than it would be for others. So again, under GAAP, how should they determine the fair value of the machinery? Now, if you have any idea how to calculate the fair value, that's great. This video probably won't be too difficult for you, but if you have no idea what it's even talking about or you don't really know, that's okay. We're going to use this explanation and the other questions in this video to learn about fair value measurement. So let's go through the options. Option A, based on Blackthorne's internal valuation, since the modifications increase its usefulness to them. Option B, based on the price a market participant would pay, assuming they are knowledgeable, willing, and operating in an orderly market. Option C, based on historical cost adjusted for depreciation and internal use. Or option D, based on the expected replacement cost of the machinery, including customization costs. Okay, so based on these different options, if you have any idea how they're going to calculate the fair value of this, then that's great. But if not, that's okay. We are going to use the explanation to learn about market participant assumptions in this question. So if you want, pause the video and think about this. If not though, let's go ahead and talk about the explanation. Okay, here we are. The answer is B. Based on the price a market participant would pay, assuming they are knowledgeable, willing, and operating in an orderly market. So that's what they would do in this situation. And again, we're learning about the market participant assumptions in this question. Fair value is based on the assumptions market participants would use in pricing the asset. This means it reflects how typical buyers and sellers in the marketplace, who are independent, informed, and not under pressure, would price the asset. Okay, so again, we're learning about what market participants are going to be assuming when they are measuring the fair value of an asset. The asset must be valued as if it were sold in an orderly transaction between willing, knowledgeable parties in the principal or most advantageous market, regardless of how the reporting entity uses or views the asset. And let's talk about what orderly transaction means, what principal or most advantageous market means as well. An orderly transaction is one that is exposed to the market for a reasonable period and is not a forced or a distressed sale. So in other words, it's kind of like a normal transaction. It's been in the market for a little bit. It's not distressed. It's not being forced. It's just a normal transaction. The principal market is the one with the highest volume and level of activity for the asset. If no principal market exists, the most advantageous market is used based on net proceeds, and we will talk about that, I believe, in question 7. Now, let's talk about some more. Unique value to the entity, like custom modifications, is not considered unless market participants would also assign value to those features. This prevents fair value from reflecting special value that only the current owner sees, ensuring the price is market-based, not entity-specific. And again, throughout this question, we're talking about the market participant assumptions. These are the things that market participants are assuming when they are going to be calculating or measuring the fair value of an asset. It's assumed that it's going to be an orderly transaction. It's assumed that it's between independent, informed individuals or companies who are not under pressure. These are the assumptions that are happening when it comes to measuring fair value in the market. So with that, now that we learned a little bit in the first question, let's go to the next question. All right, here we are at question 2. In estimating the fair value of the property under GAAP, what assumptions should Silverline use? Let's go up to the top. Silverline Corp owns a warehouse in a prime residential area. Although the building is currently used for storage, developers have expressed interest in converting the site into high-end apartments. In estimating the fair value of the property under GAAP, what assumptions should Silverline use? Okay, so let's go through the options. Option A, the value based on continued use as a warehouse, since that is its current function. Option B, the value assuming its demolition and sale for scrap, since that's the quickest transaction. Option C, the value assuming it will be used in a way that is physically possible, legally permissible, and financially feasible. And then option D, the value based on Silverline's long-term plans to keep using it as a warehouse. So again, what is going to be the estimated fair value of the property in this situation where they're trying to decide if they want to keep it as a warehouse or if they want to use it as a residential area? How are they going to determine the fair value here? If you have any idea, that's great. If not, though, that's okay. We are going to use the explanation to learn. So let's go ahead and take a look at the explanation. All right, here we are. The answer is C, the value assuming it will be used in a way that is physically possible, legally permissible, and financially feasible. That's what you're going to do in this situation. So I know that's kind of a little bit conceptual, a little bit vague, so let's talk about that a bit more. Under the fair value framework, the highest and best use assumption, which is what we're talking about in this question, applies to non-financial assets, so stuff like land in this exact example. This concept means the asset should be valued based on the use that would maximize its value to market participants, not necessarily how the owner currently uses it. The highest and best use must be physically possible, legally permissible, and financially feasible. If redevelopment into residential property meets those criteria and offers a higher value than just keeping it as a warehouse, that use determines the fair value, not the existing warehouse use. However, if it was the other way around, if for some reason the existing warehouse use was a higher value than converting it to residential use, then that would be the fair value. So when we're talking about fair value with highest and best use, you are going to be looking at non-financial assets, and basically the fair value is just based on, something that you can legally do, it's physically possible, and you can actually do it with the money. Whatever the highest value is, that's what you're going to do for the fair value when it comes to the highest and best use. So with that, we learned a little bit about highest and best use for fair value measurement. Now let's go to the next question. All right, here we are at question 3. When measuring fair value for this test, what is the appropriate unit of account? Let's go up to the top. Haven Corp is performing an impairment test on a group of assets that together generate cash flows. The group includes machinery, a building, and internally developed software. Under the applicable accounting guidance, these assets are treated as a single unit for impairment purposes. When measuring fair value for this test, what is the appropriate unit of account? So if you don't know what that means, that's okay. We're going to learn about that in this question, but let's go through the options. Option A, the combined group of assets should be valued together as the unit of account. Option B, only the most significant asset in the group should be valued. Option C, each asset should be valued individually at its standalone fair value. Or option D, fair value should be based on the lowest value asset in the group to avoid overstatement. So again, based on this group of assets, what is the fair value going to be? Are they going to do it separately? Are they going to do it based on the highest value? Or are they going to do it all together or the lowest value? How are they going to do it? If you know, that's great. If not though, maybe think about it. And when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is A, the combined group of assets should be valued together as the unit of account. So that's what we're learning about in this question is unit of account. Let's talk about that. The unit of account defines what is being measured for fair value, not how it's being measured. So in all the other ones, we're talking about how we're going to figure out the fair value measurement. But in this question, we're learning about what is going to be measured. While ASC 820, which by the way is the guideline for all this, but you probably don't need to actually know that specific number or that specific name, so don't worry too much about that. While ASC 820 provides guidance on how to measure fair value, the applicable accounting standard that we're dealing with in whatever the question is determines the unit of account. In this case, the impairment standard requires the assets to be evaluated together because they generate cash flows as a group. Therefore, the fair value should reflect the value of the entire group, not the individual parts. So again, if you ever see a question about unit of account, it's based on the accounting standard, not based on how we typically measure fair value. So depending on the accounting standard, which again, you don't need to do too much of a deep dive into this, but depending on the accounting standard, that's going to determine the unit of account, like what we are valuing, whether it's a group together or if it's individual assets. And in this case, because it's a group that they generate cash flows as a group, then the assets are grouped together for the fair value measurement. Now with that, let's go to the next question. All right, here we are at question 4. What is the fair value of the equipment? Let's go up to the top. Amber Ridge, Inc. is estimating the fair value of a piece of specialized equipment using the market approach. The company has identified 4 recent transactions involving similar equipment in active markets. Okay, so let's go through these different sales. Sale 1, $94,000. Sale 2, $88,000. Sale 3, $92,000. Sale 4, $90,000. The equipment being valued is nearly identical in age, condition, and use to those other ones. The management decides to use the median sale price as the basis for fair value. What is the fair value of the equipment? So based on the sales in the market and based on using a median sale price, if you remember what that means, they have to figure out the fair value of the equipment. Now, if you remember what median means and if you know how to do this, it's pretty simple, pretty straightforward. If you don't know, that's okay, but try it on your own if you want. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is D, $91,000. That's going to be the fair value based on what we saw in this question. So let's go through this. Under the market approach, so we're talking about the market approach in this question, which again, there's market, cost, and income approach. Under the market approach, fair value is estimated using observable prices for identical or comparable assets in active markets. This method assumes that market participants would rely on recent transaction prices to determine value. Here we use the median value of the recent transactions. So as far as what I've seen, frequently you're going to be using the median value when it comes to the market approach. Maybe there's other ways to do it as well, but this is one way that I wanted to show you. To find the median of the four values, you have to order them. So go from lowest to highest, 88,000, 90,000, 92,000, 94,000. Since there's an even number of data points, the median is the average of the two middle numbers. So remember, median is middle. It's not the mean, which would be the average, but it's the middle. Now, when you have an even amount or an even number of values, when it comes to doing the median, you have to take the two middle values and divide them and average them, and that will give you the median amount. But if there had been five numbers, if there was like a sale that was 91,000 in between these ones, we wouldn't even have to do that math. We would just look and say, hey, 91,000 is the exact middle. That's the median. So that's what you would do. But in this case, there was an even amount of values. So again, 90,000 plus 92,000 divided by 2 to get the average, and that gives us 91,000, and that is the median. Therefore, the fair value is 91,000 using the market approach and the median of comparable sales. So again, we learned how to calculate something with the median value with the market approach in this question. Now let's go to the next question. All right, here we are at question 5. Given these circumstances, which valuation approach would be most appropriate to measure fair value? Let's go up to the top. Frostline Corp is estimating the fair value of a custom-built warehouse it owns in a remote area. There are no active markets for similar properties in the region, and the building is not expected to generate significant income on its own. Again, given these circumstances, which valuation approach would be most appropriate to measure fair value? So let's go through this. Option A, market approach, which we just talked about a little bit, since all real estate should be valued based on comparable sales. Option B, income approach, since all assets have future cash flow potential. Option C, cost approach, since the building is unique and market/income data is limited. Or option D, book value approach, since no observable market prices are available. So again, what approach are they going to be using to value it for the fair value in this situation? Now, again, based on what we've learned so far, you might have a guess, but if not, that's okay. We're going to look at the explanation to learn about this together. All right, here we are at the answer C. We would use the cost approach since the building is unique and market/income data is limited. And by the way, potentially you might have used the cost approach for the first question in this video where they had a unique or special asset, potentially. Not saying you for sure would have, but it kind of sounds like what we're talking about here. The cost approach is typically used when market data and income projections are not reliable or available, and the asset is specialized or unique, such as custom buildings or internal use assets. It estimates fair value based on the cost to replace or reproduce the asset adjusted for depreciation. This approach is appropriate when the asset doesn't have a readily observable market price and doesn't directly generate income, making the market or income approaches unsuitable. So again, when you don't have very much market data, when you don't really have any income projections either, then you want to use the cost approach, which again is based on the amount it would cost to replace or reproduce the asset. So we learned a little bit more about the cost approach there. Now let's go to the next question. All right, here we are at question 6. Using the constant growth dividend discount model, what is the fair value of one share of this investment? Let's go up to the top. Riverbend Inc. is estimating the fair value of an investment in an equity security using the income approach. The security is expected to pay annual dividends of $4 per share next year, and dividends are expected to grow at a constant rate of 3% annually. Based on current market conditions, Riverbend believes a 10% discount rate reflects the return a market participant would require. Okay, so let's go through this. Again, using the constant growth dividend discount model, what is the fair value of one share of the investment? Now, if you have no idea what the dividend discount model is, that's okay. And if you don't know how to do this, again, that's okay. But if you want to give this a try, maybe pause the video and think through this. And when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. A, $57.14. That's the amount that the fair value of one share of this investment. Again, we're learning about the income approach in this question, so let's go through this. Under the income approach, fair value is determined by discounting expected future economic benefits, such as dividends or cash flows, to their present value. The constant growth dividend discount model, or DDM, is used when dividends are expected to grow at a steady rate. And, this question is specifically about the income approach, but this is one way that you could see something about the income approach is by having to apply the DDM. So fair value in this case would equal the next year's dividend divided by the discount rate less the growth rate. So we go down here to figure out the fair value. $4 divided by 0.1 less 0.03. So that's $4 divided by 0.07, and that gives you $57.14 of fair value for one share of the investment. This model assumes market participants are rational and would factor in both the required rate of return and long-term growth when pricing the investment. The main thing I want you to learn here is that with the income approach, you are trying to figure out the fair value based on the expected future economic benefits, such as dividends or cash flows. And in this case, we're using the DDM, the dividend discount model, to figure that out. But the main thing I want you to remember is that the income approach is going to base the fair value off of, again, the discounted expected future economic benefits of something. So with that, let's go to the next question. All right, here we are at question 7. Which value should Clearwell use as the fair value of the commodity? Let's go up to the top. Clearwell Corp is estimating the fair value of a commodity. It does not have a principal market for this asset, but it has access to 2 active markets. So Market X has a quoted price of $130 and transaction costs of $10. Market Y has a quoted price of $125 and transaction costs of $2. So again, which value are they going to use as the fair value of the commodity? So are they going to use the market X price? Are they going to use market Y? Are they going to use the quoted price or a different number? If you know how this works, that's great. If not, though, if you don't know how to calculate the fair value when there's no principal market, that's okay. We are going to use this question to learn about that. But if you want, pause the video, give it a try, and when you're ready, come back. We'll look at the answer together. All right, here we are at the answer C, $125 based on the quoted price in market Y. So let's learn about this. When there is no principal market, which remember is where there's the highest volume, the highest amount of transactions, things like that. If there's no principal market, fair value is based on the most advantageous market, the one that maximizes the amount Clearwell would receive or minimizes the amount paid after transaction costs. However, once the most advantageous market is identified, fair value is based on the quoted price in that market, not the net amount. So there's 2 steps here. First, you have to figure out the most advantageous market, which is by figuring out the best net proceeds. So in this case, it's either market X or market Y. The net of market X is $130 less the $10 of transactions equaling $120, but market Y is $125 less $2 of transactions equaling $123. So between these two, market Y is the most advantageous when it comes to the net proceeds. This is where they make the most money or get the most money or save the most money, however you want to say it. So market Y is the most advantageous, but that does not mean that $123 is the fair value that we're going to use. All we were doing there is figuring out which one is most advantageous. Now that we know that market Y is the most advantageous market, and fair value is the quoted price in that market, which is $125. So you do this to figure out the most advantageous market, but once you know that, you use the quoted price as the fair value. If Clearwell had a principal market, it would have to use that market's quoted price even if another market provided a better net outcome. So between the two, between most advantageous and principal, in this case, if, for example, market X was the principal market, even though it's less advantageous than market Y, if it was the principal market, that is the fair value that we would use. So we would use $130 as the fair value if that was the principal market. Same thing with market Y. If market Y was the principal market, doesn't matter if market X is more or less advantageous, market Y is what we're going to base the fair value off of. But if there's no principal market, that's where you do this most advantageous calculation to see which one has the better net proceeds. And then based on which one has the better net proceeds, you use that one's quoted price as the fair value. So we learned about principal and most advantageous in this question. Now, before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 questions trying to teach you about how to calculate things with the most advantageous market versus the principal market, or whatever the case is. Again, you notice these things throughout the questions, and so you take a moment and write them out in your own words as the Pillar Topics based on the most important things you learned from the questions. And as you're doing this each day, you are building your own personal repository of the most important things you need to know for the exams based on what you learned from the questions. So let's go ahead and take a look at the Pillar Topics for this video. All right, here we are at the Pillar Topics. Let's just dive straight in. First off, fair value is based on assumptions that market participants would use, not the reporting entity's unique perspective, assuming an orderly transaction between knowledgeable, willing parties. So again, there's basic assumptions when it comes to fair value that it's between market participants and it's orderly transactions and things like that. Now, highest and best use applies to non-financial assets and reflects the most valuable use that is physically possible, legally permissible, and financially feasible for market participants. So again, with a piece of land, whatever the highest value you can have from using that land, whether it's keeping the land for warehouse or whether it's turning it into residential property, that's going to be what you use for the fair value. The unit of account defines what is being measured for fair value, such as an individual asset or a group of assets, and is determined by the applicable accounting standard, not by ASC 820. And remember, ASC 820, you probably don't need to remember that. Just remember everything else we're learning in this video. Now let's talk about the different approaches. The market approach estimates fair value using observable prices for identical or similar assets. And if the median is used, it should be correctly calculated based on the number of data points. And remember, with that one, there was an even number. There was 4 data points. And since the median is the middle, we had to take the 2 middle data points and divide them, average them so that we could get the actual median. Now let's talk about the cost approach. The cost approach is used when market or income data is unavailable, particularly for unique or specialized assets, and is based on the cost to replace or reproduce the asset adjusted for depreciation. Now let's talk about the income approach. And this estimates fair value by discounting future benefits to present value, and when using a constant growth model, fair value equals next year's cash flow dividend by the discount rate minus the growth rate. The most important thing you need to remember from that, though, is again, the income approach bases or estimates fair value on discounting future benefits to present value. And then finally, let's talk about principal and most advantageous. If a principal market exists, fair value must be based on the quoted price in that market. It's as simple as that. If no principal market exists, use the most advantageous market based on net proceeds, but still apply the quoted price, not the net, as the fair value. So again, those were the pillar topics. Those were the basic ideas, the most important things that we were supposed to learn from the questions that we did in this video. And with that, that is the end of the YouTube version of this video. Remember, in today's video, we only went over 7 questions, and this time there's only going to be 7 questions for the member version as well. But normally there are going to be 5 questions for the YouTube video and 10 questions for the member version of the video. So if you like this and you like our other products, make sure you check out becoming a Superfast CPA Pro member to get access to the full versions of these YouTube videos and to get other resources as well, including the Pro course where we explain in depth how to pass the CPA exam. And speaking of, the tips on how to pass the CPA exam, one of the best things that you could do is go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So watch that webinar, and that will give you a good path and a good idea of how to become a Superfast CPA Pro member, and then you can become a Pro member as well. So check out the webinar, check out becoming a Pro member. Now, if you found this video helpful and you liked it, make sure to like it and leave a comment in the YouTube video. I hope this video was helpful, and I will see you in the next video.